one. And we're live.
All right, welcome to 2023. Are we still taming? Increases above 6%. Silicon Valley Bank fails. First Republic Bank sells off in fear of failure. What was the other one? The SIVB Bank fails. So all of a sudden you have all these headlines. If you were on a desert island reading these things, what would you think the stock market's doing in that?
I mean, maybe a dumpster fire. It would be down.
Cratering, yeah.
Cratering, right.
Yeah, and what has happened?
2008.
Yeah, it feels very 2008-ish, and amazingly, as you can tell here, the market's been able to hold its ground. So that's raised a lot of question for people, especially like us who've been since January of 22. We've been saying we're in a bear market. And since June of last year, it's amazing that it's been 9 months since we said there's going to be a bear market rally. So the question is, with all this bad news, why is the market not making new lows? And that's a valid question. It's like, is the market that resilient? Or are these just setting the stage for something else to happen? Because like in 08, the first bank to go down was IndyMac. Right. And they went down, I think it was July of 2008. And then it wasn't all the way until September that the big domino, Lehman Brothers, went down. So you had this stretch. And I remember in that same time frame, markets were steady. They were holding their ground, and people were thinking, this is. I remember them excusing IndyMac away, saying, those guys were always partying with their pants down. They had the most subprime mortgages, that kind of stuff. Kind of the same way that they're, saying with Silicon Valley Bank, that is very unique to that situation. So I just think it's really interesting because with bank failures, Treasury bonds, interest rates. Those have been the biggest questions. We just did our client event on Thursday. Out of that client event, guys, what do you think were the biggest questions that you heard from people that we should address today?
Bank failures.
Bank failures?
Was one.
Yeah.
Well, and to say that, to go backtrack, because bank failures happened in 08, that's not to say that just because some have failed now, that's what's going to trigger going forward. But I think more so people are worried about their cash inside the aspect of bank failures.
Yeah, there's a lot of questions about is my cash safe?
Can I go down there and still grab it?
Yeah, and of course the questions of can the government come in and take my bank account or take my IRA? We seem to get a lot of those questions, which we won't delve too much into, but we'll try and stay on the topics of the market today and not go down those rabbit holes. And then what we'll also talk about is the stock market. I think has been a really big question. People are wondering what next. Where do you go now if the bear market's over? Are we going to rally to new highs, or are we still just in this mix of a bear market rally and we should be more cautious? So we'll discuss that, and we'll let the charts tell us what's going on there. Bottom line really is it's our story on the stock market really hasn't changed in many, many months. So we'll just recap that. Last year, there was a lot of conversation about the dollar. The dollar's strength. While most people are getting marketing material talking about the demise of the dollar, we get a lot of questions around that. Is what's happening with a digital currency? Is that a threat to the dollar? And yes, you know what? We're going to talk a little bit about when we get into the charts that the dollar is on this momentous change that takes 100 years. And this is how fiat currencies and reserve currencies, and we saw it with Great Britain was the first one that in modern history that you can look at where it took 100 years for another currency to replace that, which was the U.S. dollar. Now we're in a situation that, globally, there's some things happening between China, Saudi, Russia with, basically what we are starting to consider our enemies, okay, or not such our allies, where they are going to look to trade oil and gold and things in other currencies than the dollar. So, yeah, there's a change happening there, and it shouldn't be scary if you're expecting it. If you're not expecting it, you're not prepared for it, then it could be a scary thing. So we'll talk about that, how to prepare for that kind of environment. And then really when you look at what's happened since the beginning of the year, nothing gets gold and metals really moving more than bank failures.
Yeah.
I mean, gee whiz. So are we going to, are we in the 1970s? Are we in a situation where for the next handful of years, investors are better off looking at the commodity space and as opposed to the technology space for growth? So we'll talk a little bit about that as we get into the charts too. So that fair with you guys?
Sounds great.
All right, let's start off with some market performance. What's going on this year, guys?
Well, if you watched the S&P since the beginning of the year, I think we hit at a high. We were up 8%, and then we've had a little bit of a relief with all the headlines and all that type of stuff. So we're only up a little over 3%. And surprisingly, a lot of the tech stocks have really rallied during this time.
You had the
time
NASDAQ.
frame.
Yeah.
Yeah. So the NASDAQ's up over almost 13%. But then your typical Dow, which the NASDAQ is a little more important than the Dow. It's only 30 stocks, but it's still down overall, kind of giving you that industrial strength aspect of things.
Yeah, what's interesting there is last year in 2022, NASDAQ had its worst performance out of all the indexes, down around 30%. The Dow had the best. It was down only maybe 10 or somewhere around there. And so now this year you've got that flip side. It looks like this reflex rally, and the NASDAQ has come back. I think a lot of that, though, I know, Justin, you watch these more than I do, but I think a lot of that was Tesla and NVIDIA. I think it could have been concentrated to just a handful of stocks.
Yeah.
Well, not only that, but watch out for when you get your statements for this quarter, because they're going to lean into the fact that the S&P is up, the NASDAQ is up, so your statements might show up year to date. But take it back to last year to compare where your statement might not be up year to date is something to take into consideration.
Well, the big difference, too, is this 10-year Treasury. Last year, you had a 10-year Treasury that was rising. So if you had a portfolio that was half stocks, half Treasury bonds, or 60-40, whatever it may be, you were getting whacked on both sides. Market was going down. Your Treasury bonds were going down. This year, we've stabilized there. The Treasury market has stabilized because, as you can see here, the 10-year's gone from 3.3 to 3.8 has kind of been the range, and we started at 3.8 and have come down and back around. So it's been a tamer interest rate environment for people's portfolios. So people definitely have felt a little bit of a little reprieve the last 5-6 months.
On the mid to long, what we're not showing here is the short-term side.
Yeah.
It's had much more volatility this year than it did last year.
Incredible volatility.
A lot of volatility, and that's going to continue. Interest rates are going to have a lot of volatility. There's a lot going on there.
So we've got, gold's been up. We were a big proponent of that at the beginning of the year, as well as starting towards the tail end of last year. I'm still a big proponent of it. As you mentioned, the banks going under, a few of the banks going under. I think a lot of people got a little nervous around that. So the flight to that has shown you're up about 7.5%. What's interesting here, though, is the two commodities, oil and natural gas, especially natural gas, has taken it in the shorts.
Yep.
I mean, down 43%, so contrary to, what we believe is something could be a potential gainer later this year, is definitely down quite a bit this year. So you got oil 14% down so far in the first quarter, natural gas 43%. And then corporate bonds are about the same, but I know we're going to be looking there hopefully later this year if we can get some good prices in corporate bonds.
Out of all those things, there's a good lesson for investors to learn from that list. If you look at last year, natural gas was the big performer.
Yeah.
There was a point last year natural gas was up 70-80%. We talked a lot about that, and for our portfolios and our models, we played that quite well. We had some good entry and exits, and it was a great example of don't overstay your welcome in commodity spaces.
Definitely.
because they shift a lot. So now you have a situation that was the best performer last year is the worst performer this year, and so the lesson for investors is don't make this year's decisions based on last year's performance.
Right.
Like you cannot look backwards and make your decisions that are forward looking. Right? And so this is a great example of past performance is not indicative of what can happen next.
Future, yeah.
So I think that's a really good. This year is a perfect example of how the first 3 months have been complete flip side of the last, or that, let's say from March to June of last year.
And on the flip side of that, of also a perfect example is gold has been historically an inflation hedge and something that people run to, and there were a lot of speculation that, they're not going to run to that. They're going to run to Bitcoin or all these other type of stuff. And this year has proven that history is going to repeat itself, and gold is going to be the safe haven.
Okay.
Well, and I would add too, I mean, last year we had, the market was down, and even then people weren't flighting to gold. It wasn't until the bank failures started showing up. And I mean, gold was already trending, upwards in general when the year started. So before some of this happened, but I mean,
we had Bitcoin fail and all that type of stuff.
Right.
Yeah.
Fail,
When I look at the chart of gold, which I just put up here, and it goes from 2013 to current, or actually to June. This is our chart from June of last year. So I'm going a little bit backwards to go forwards. You can see it's been a very sneaky gold rally, right? From the bottom in 2016 to now, there's been a pretty damn good return. However, just like you were saying, Justin, from 2020, the middle of 2020 through 2022, to now, the beginning of 2023. So it's been like a 2-year process, 2.5-year process, where gold's been consolidating in a fourth wave. That's what fourth waves do. Fourth waves churn and take up time, get people bored, and exit their position because there's got no momentum, and then the fifth wave happens. And the reason it's a fifth wave, because that fourth wave churning people up, it eats up a lot of the volume. It takes a lot of the fuel out of the tank. So the fifth wave then comes, and that's what creates that loss of momentum when the fifth wave finally starts getting to a certain level. You lose buyers, right? And so this is our chart in June, and then when I come to now. You can start to see here, and over the last couple of days since I did this chart, gold started to break out to almost new highs. It really looks like it's doing that. So my conviction that, hey, we're in a fifth wave, that our chart patterns here are correct, is incredibly high on this.
Yeah, I would agree.
Yeah, and so I think that gold has a little more to run, but realize this, it's a fifth wave, right? So
there's not a sixth?
Yeah, it could, but at the smart money is at some point, if you're riding the gold wave in the near future, handful of months, maybe a year, whatever it may be, you're going to need to be looking for your exit. Because there again, this might be 2023's best performer and could be 2024's worst performer. And you don't want to be there, So while I really like gold and gold miners, I like them on a short leash at this point.
Don't get too greedy.
Yeah. What did they say? Bulls make money, bears make money.
Pigs get slaughtered.
There you go. All right. So I don't know if you guys have any fundamental reason to believe or technical reason to dispute the fact that this bottom line in metals, and this is gold and silver and other metals, but for the most part, we're using gold as our visual proxy. I like I said, I think you got more room for rally, but be careful.
And, I don't know what the answer here is, but I know that, with a lot of this geopolitical stuff going on and some of this talk of digital currencies, I know, China and maybe not so much Russia, but for sure China is, buying and mining a lot of gold.
Yeah.
So they're definitely, I think we mentioned it at the event, if they do a digital currency or some version of that, maybe it'll be backed by, their gold standard.
Yeah.
Something like that.
And we talked about doing or settling oil and natural gas and other currencies.
Yeah.
Right now, the currencies are backed or benchmarked to the dollar.
Yeah.
So if they're going to start doing that, they're going to need to start benchmarking to something. Gold might come back into play to do that type of deal. Otherwise, you're just benchmarking it to the dollar anyways. So the dollar is still needed, which is kind of counterintuitive to what a lot of people are saying. So.
Yeah, you guys have heard me talk about the podcast that George Noble has called No Bull, and I'll say that he's got some very bright people on there, and a lot of what I've gotten from there, they've been contrary to a lot of other people's beliefs, and they've been dead on. And in a recent podcast that I listened to them, one of his guests that seemed very knowledgeable, has a big background in metals, was just sharing that what you have going on in the digital currency side is, and since really January, the Saudis have become very vocal that they're willing and able and setting up processes to trade oil in other currencies. And the belief system, or what is being talked about that's happening behind the scenes, is that you have this kind of coalition. Let's say maybe it's between Saudi, China, Russia, and name anybody else you want to mix in there, like North Korea or whatever it may be. And they'll have a digital currency that has some kind of pseudo backing of a hard asset, and so these central banks in those countries are picking up more and more gold. There's an assumption that this is part of a process that sometime this year they're going to come out with a digital currency. Maybe it's backed by gold, or maybe it's backed by some kind of implied nature of gold, whatever it may be, in order to give people confidence to start to use it and trade oil and other assets within that. So that's one of those things that if you're hearing that kind of stuff for the first time, you go, holy shit, well, my gosh, but if you're expecting it, then you can prepare for it, because there will be opportunities to take advantage of something that seems so contrary or threatening to the U.S. dollar. So if you're not expecting it, it could be scary. But if you are expecting it, hey, we can prepare. We can look at assets that could benefit from that.
Yeah, look for opportunities.
Which could be gold, right? I mean, obviously supply and demand here. So there's just a lot happening there that's both geopolitical and just cycles.
Yep. Shift in the tide.
In cycles. So it seems like we've got the trend. So we don't need to beat that horse. And the flip side of that is the big driver there is the U.S. dollar. So a lot of we've been bullish of the dollar for a couple of years here. It made sense. In this chart, you can see from 2013 all the way up until the end of last year, the dollar's had more strength than weakness, even in the midst of all the emails that people are getting about, the dollar's going to doomsday.
Go to zero.
Buy bullets, Butterfingers, and gold, and hide in your bunker.
Bullion.
And billion, yeah.
Bullion.
Bullion.
We were going to do a joke at the beginning because it's Easter coming up, saying find the triple B's for the egg hunt, where you say bullets,
Butterfingers, and bullion.
Yeah, triple B's, the triple B bonds and those sectors.
Yeah.
So what it looks like to me in this kind of chart of the dollar, it looks like that near term we continue to have a little weakness. I think that helps fuel a little upside to gold and even possibly the stock market for a few weeks. But I think also if we get into the next phase of a crisis, that's typically dollar strength. So I think what we're experiencing right now is a big macro fourth wave, just like you saw in gold. We're kind of experiencing that in the dollar. And maybe what coincides with the peak in gold of that fifth wave is eventually the dollar gets some footing here and starts to go into its last phase of secular growth. And same thing with the dollar is the next growth phase that happens here is probably on a short leash. It's this growth phase has been going on for 8 years.
Right.
Well, and some that might impact that, we're going into a recession where gold and dollar kind of fight each other for the prime.
Exactly.
So that can have an effect on it too going forward.
Yeah, you definitely have a tug of war here. And so the charts and the fundamentals seem to be kind of aligning. So right now, this is what I think we continue to expect. So from an investor perspective, there's really nothing I see in the near term, the next 3, 4, 5 months that's happening in the dollar that you need to really factor into a portfolio. Now after that we'll talk more about it, but it's not a concern for me right now in a portfolio. I don't know if it is for you guys, but
yeah, I mean, I would just say that you can see, like we talked about with gold, same, I mean, look at it, I mean, it chopped around for so many years, even though the trend was slightly up, I mean, it's, you held it, bought it here, it didn't really do much for, call it 5-6 years for you.
Well, this is what happens in currencies. They're long trends that you have to be very patient.
Yeah.
And you don't want to sit on them all the time. That's why being tactical and strategic, it makes sense. So I don't have anything that is really different from what we've communicated the last 6 months in the dollar. I don't think much changes there over the next 3 months. I think it will become a bigger conversation point later in the year, but for right now, no need to waste time on it.
Video clip from the Jetsons.
Yeah, that was the Jetsons. Yes, yeah. Do you like that? Yeah, yeah. That was the old clip from the Jetsons. I miss the Jetsons.
I do too. That was a good
I
show.
miss old school TV.
Yeah.
Yeah, I'm ready to go back to the rabbit ears.
I miss Looney Tunes.
All right, so let's talk about the stock market and kind of wrap things up after this with a little conversation on oil afterwards,
Yeah.
because I think that's a big, we've been, big proponents of energy and oil, and we'll give you an update on that, because if there's anything that we've been early on, it's that. Early
say
is
the
wrong.
least.
Yeah. So well, we were right, and then we were early again. So
shifted on us.
yeah, we'll talk about that in a second. So the stock market back in June of last year, when the markets were making lows for this bear market decline, things were pretty grim in people's attitudes. And we said, okay, we should expect some kind of bear market rally. And since then, and we shared that chart. Since then, in December, January, we came back out and said, you know what? We still believe it's a bear market rally. You can see Justin maybe point out there in October at the bottom.
Oh, yeah, right here.
That, we bottomed out in October, really. And since then have just been grinding higher. And so we drew this line of demarcation that said if the market is above that blue line, it's probably have as an attraction higher. And in the last few weeks, people have gotten incredibly negative. Everybody's expecting the market to crash. And then especially when you got all the bank failures coming out, everybody was expecting that we'd already be. This is the S&P 500 is at 4,100 right now. People would have been expecting it down at 3,000, 3,500, right? With everything that's been going on, that hasn't happened. That's what happens in bear market rallies is you get these little short squeezes that keep going. Eventually it'll lose steam, but we're just not there yet. And markets love to create maximum frustration. That's it. So what I would think happens here is while everybody's super negative expecting the market to go down, what does it do? Probably squeezes a little bit higher, like we have here on the chart, maybe 42, 43, 4,400 even. Mm-hmm. I don't know if it has that much fuel in there, but possibly. And then I think later, then I think you roll over. So that the what we said in January, the pay me now, pay me later market, my attitude hasn't changed.
Yeah, same.
And our allocation shows it. Our exposure to the stock market is less than 10% for a reason.
Well, and the market's had a real tough time getting over that 40, at least the S&P getting over that 4150 mark.
Yeah.
I mean, the minute it gets over that, everybody's selling.
Yeah. Somebody's coming in just whacking it.
Yeah.
So
well, that's what you said, the frustration. It might get up there, and it's going to give you the thought that it's going to go down, and then it turns and rips higher again. So.
Yeah.
Well, and right after those, the last few weeks, there was a huge number of shorts out there, and what did the market do? We ended up on an up week.
Yeah.
Squeezed everybody out of those.
Yeah. Yeah, and that's the treacherous part of the market. Bear market rallies are really hard to play, and so that's why it's just best to be patient and not do a lot. And so it's the next move that matters. And so right now it's best just to kind of sit back and wait for the ball to come into your mitt, and then look for the next play after that.
Yeah.
So I'm glad we don't have a lot of exposure there, but I'm open-minded. To doing all kinds of things in the market. I'm excited, though. I'm incredibly excited that if this is true, like if we've got our pattern right, that means in like 3, 4, 5 months, we could be like seeing some incredible bargains. I mean, we could be sitting there going, wow, if I buy this, I may not need to look back for many, many years. So it's really important for people not to be fearful of this. We need this to happen. We need this cycle to go all the way through. We need bankruptcies. We need failures. We need these things to happen so the Fed can say, okay, we were successful. We brought inflation down. We did some wealth destruction. That's exactly what we were trying to do. Now we can reverse course.
Well, it's like you said at the client meeting, in a bear market, we're not stock picking because we'll buy ETFs because in a bear market everything goes down, whereas when we have those opportunities, that's when we're going to be picking off stocks one by one because those are going to be the ones that are going to show the rally and show the performance.
When the tide is dropping, I don't want to be in a boat, I want to be in a plane. That's why we got you, Patrick.
Take you anywhere.
Yeah, we got you. You can take us on your plane.
Bottom or top.
So bottom line is this: is we really don't feel that anything's really changed in our viewpoint of the market. The green line there, that is like critical support. That like once you, if and when you break that, then we'll have another confirmed downtrend. But a lot could happen before that comes, if it happens. But from an equity perspective, if you're not a Quiver client and you have your 401k or your account somewhere else and it's heavy in equities, then you may want to reach out to us and have a conversation about what you need, because everybody's situation is different. So some people may need to do something about it, other people's may not. So.
And at this point, why are you not a Quiver client?
Yeah. Well, yeah. All right. So let's move on from there and wrap it up with oil, because this is something, we 2 months ago we put out our Catching the Next Wave newsletter. We highlighted the energy sector, and I purposely did it right around that time frame because I felt that short term there could be some softness in oil and in energy names that I would want to buy into, because while I felt like for the first quarter of this year, oil prices could be soft based on the charts. And we talked about this last time that we felt oil was consolidating off of the first kind of bear market or bull market rally that it's creating, and we're expecting another rally of similar size. And so this is just that kind of consolidation period where a market that grows can correct by time or price, and this one's doing it really with time and price. So those two green lines are really, really key. It's a big support zone. That's a problem with big support zones, is you got to give it patience of like a 10% range, which is not easy to do. And so we're resting right now in oil. We bounced off of it this past week, that dark green line. So right now, that critical support line for oil looks like it's held. And it looks like, and I think of the next few weeks, the next 5% in oil could be up or down. I don't know what it is, but I still believe the next 50% or 30% is higher, not lower. And our thesis in our Catch the Next Wave was really it's around supply issues. You've got some demand things because China's coming back online, but more so you've got some supply issues. And then also geopolitically, if we have what we talked about in the dollar and in gold and foreign currencies trading oil, I think we start to get really in a situation where the Saudis, it really benefits them to keep pushing prices higher. I also think the Saudis are at an age where they need to make this their last hurrah. Not that they don't have enough money already, but when you're 50 and you want to call it quits, the next 10 years you probably push oil as high as you can and make as much money as you can. So,
and that being said, that's maybe the Saudis' view, but we have a lot of oil and gas investments in the alt space, and a lot of the oil companies aren't actually in favor of $200, $150 oil because it just creates so much destruction, so much long-term pain that they're fine with $70 to $80 a barrel oil. It's not like they want that to potentially happen on the U.S. side.
No, I don't think anybody really wants it.
Other than the Saudis.
2035, somebody's going to have to make a decision.
Yeah.
Because we're supposed to be changing over all vehicles in 2035, according to...
Well, and that's why I think
the rhetoric.
Now you're getting political.
That's why I feel
changing. Yeah,
that's why I feel that's where you come into supply issues, is because we've had such a big ESG environmental move around this. You've kind of the last 10 years, you've really shut off a lot of supply. You've shut off a lot of drilling. You've shut off a lot of things in anticipation of more solar and wind. And now we're starting to see that we didn't really plan this out. When you see that a perfect
example to the government.
Well, yeah, I mean, a perfect example is I would love to see electric cars really be perfect for the environment, right? But then when I read articles about, you know what, you get in a small fender bender with a Tesla and they end up scrapping it because the expense to repair the battery is so high. The insurance company's like, so now you all of a sudden you have cars with very minor damage that are going off and getting scrapped. And now that's just adding to the environment. That wasn't thought out.
Right.
Yep.
And normally you would have had an industry that says, hey, let's make sure it's right for the consumer, including replacement value. Right. That wasn't thought through.
Or take it granular, and the fact that all battery cars are twice as heavy as a regular vehicle, causing more wear and tear on the roads and tires and all that type of stuff, which is increasing expenses.
Yeah. So I think all those things, the whole ESG movement has just helped add to the demand in oil, and it's kind of gotten the unintended consequence of a good idea. And bad execution.
Right.
And it'll get better. But in the near term, from an investment perspective, I like the idea of watching oil. And that green line is really, really crucial. If we break below that and say have sustained trade below that, then the whole thesis on oil is completely wrong. I'll have to save fate. I don't know what. I'll do something in embarrassment of being wrong.
Our next video.
Yeah. So stay tuned, because we'll see. Because I do think that this is going to be a big topic over the next year, along with gold and along with other things like that. So, bottom line for if you're a client, if you're a Quiver client, and you're saying, okay, great, Colby. Patrick, Justin, I get it. You think gold's looking stronger. Oil is an interested area that you want to, maybe lean more into if it holds support. You believe interest rates are lower in the near term, but higher eventually, So what do you do with a portfolio like that? What do you do with my cash? If I'm scared about bank failures, things like that. So what we've really figured that we've started to do is that why wouldn't an investor just keep their life as simple as possible and do a third of their money in things that are cash or treasuries, like high-yielding cash instruments, right? Because you can get, like our Stonecastle account that pays 4.2 or 4.4 now, or something.
4.24, yeah.
It's 4 points, almost 4.25, let's call it.
Yeah.
And it's completely liquid. And then you can go out and buy a 1-year treasury, and we're seeing things 5.25, 5.5. And then with another third of your money, go where the momentum is. So obviously, the stock market doesn't look like it has much momentum, but metals do, right? Hopefully, oil will look like it has some. So why not, if you're going to take risk, let's put it in the areas that have a rising tide, not a dropping tide.
Right.
So energy, metals, basic materials. Last year, one of the greatest sectors was aerospace and defense. So we'll see if that continues this year. We don't make your decisions based on last year, but do look what's happening this year, because it doesn't look all that bad.
Right.
And then have another third of the money in our models that are basically designed to kind of hedge the market. If the market's going up, we'll be in the market. If the market's going down, we'll be other places. So I call those alternatives, because they're things that can shift and change with the aspects of the market. And then along with that, you should probably have some alternatives that are income producing.
Yeah, income producing for sure.
Yeah, and that's Patrick's
Cash flow.
area. This market really becomes like, Patrick, we've talked about it before, like you really got to bone up your knowledge on what your alternatives are, because you need more things that do not correlate to the stock market or the corporate bond market. And especially if you need to create stability and income on a portfolio. So in my mind, when I look at a mix like this, a third, I feel like, hey, I'm in a pontoon boat. Like I feel like, hey, I've built a nice raft around me that can endure whatever comes this way or that way, but I also have the opportunity to, get some growth out of it if we're right in the areas of commodities and energy-related type of stuff. So that just seems to make the most sense, and that's where we've kind of seen our models alter and change to. And then for those of you that receive our 401k guidance, you'll see that in our allocation guidance that we give for the 401ks, it's very similar to this as well.
Yeah. And I think if you're listening and looking at this, you should take a more overview of it, that we're not shooting for the moon on returns. Near term, we want consistent, stable type of returns. So nothing, exponential growth type of thing during this near term because of the volatility, because of the uncertainty that's going on.
More cash flow.
Yeah, I mean, there's times to take risk. It's there's environments that it makes sense, and this just doesn't seem to be one of those. Right. So it doesn't mean that you have to hide. It just means you have to be more thoughtful on how you allocate, and it doesn't have to be difficult. This is a very simple allocation with a very thoughtful process of the trends in mind.
And we're seeing it with the big boys. All of the big boys are buying the treasuries. You can't get much better paper right now.
Yeah, here's the question that's come up though. Like one of the things that came up with the bank failures is that people heard in the news that one of the reasons that these banks failed is because they had toxic treasuries. And so I've had that question come like, what's a toxic treasury? And it's like, well, that's a media thing. They give that's so you read, put the word toxic. People go, what? So that's brought up when I've said to people, hey, you should, include more 1-year treasuries in your portfolio, build a bond ladder. The questions come up, is that safe? I heard treasuries are dangerous. So, and what you have to, and I get that, but when you're buying treasuries that are maturing in a year or less, the risk that those banks had is what they call interest rate risk, and they were buying bonds that were maturing in 10 years, 20 years. So when interest rates rise now and you have a bond that matures in 10 years, the price of that bond is going to shift around a lot. But if you have a bond that matures in a year from now, the interest rate change in the near term may cause your bond price temporarily to go down a little bit, but it doesn't matter if you're waiting to the maturity date. Right. And if you're waiting to the year, the bond matures, you get your money back, and everything about the price that happened from the moment you bought it to the moment that matured was irrelevant. It was entertainment, right?
Yeah.
So if you're buying or if you're building a bond ladder that is built with short-term treasuries, you're not going to get toxic treasuries. That's not going to happen. If you go out and buy a bond mutual fund and even some bond exchange-traded funds or some exchange-traded notes, then yes, you could find some toxic assets, because you have to remember, Wall Street loves to take things like dog crap and wrap it with cat crap and call it a Tootsie Roll. Right? So that's, so when you get into some of these bond products like funds and things like that, yes, you have to be a bigger discerning consumer. You have to do more homework.
Yeah.
But if you're building a bond ladder, like what we're talking about here, buying the bonds and no middleman other than who's helping you buy them, then it's a completely different situation.
Well, and if you're worried about what, if SVB or some of the ones that failed, whether or not they're a systemic issue, reach out and we can explain to you the nuances and the differences of why it's that type of situation is not a systemic issue in most banks.
Yeah, and it's really important to understand that the banks that had problems were regional banks. Now, it doesn't mean that there's not going to be other problems.
Right.
Like the goal of this cycle of the Fed is to create wealth destruction. And they have to create bankruptcies in the corporate space. So companies that borrowed money from Wall Street, so I've talked about this before, I'll use Sunrun as an example. They borrow money from Wall Street, they sell bonds, and they have to pay 7-8% on those bonds, or even 6%. They take that money, they use that money to finance the people who put solar panels on their roof, but they finance that over 20 years or 30 years. So it's a big, long, and they charge them 3%, 2%, 4%. It's lower than what they're servicing their debt on. That kind of business model is what will blow up in this kind of environment. And so there are companies that have REITs that have done the same kind of model in commercial real estate. And in commercial real estate, you're going to re-up your loan every 5 to 7 years. And so if you've gone through an interest rate hike in that time frame and you're a commercial real estate owner and you need to go refinance your property and now rates are a lot higher, you could have a problem. So that's another area that so like if you're banking at a regional bank or you're banking at a credit union, the question to be asking your bankers is, what did you do in the real estate market over the last 10 years? What kinds of loans did you extend out there? What kinds of loan, so that would be like that as a consumer, if I was banking at a bank that issued a lot of loans over the last 10 years to commercial real estate that's on readjustments of every 5 or 7 years, then those are the banks that are going to be on the watch list.
Yeah.
Okay. So, if you guys out there have questions about whether your bank is safe, whether your portfolio is safe, what you can do. That was one of the big questions we got from clients is, hey, what type of accounts is my money safest in, right? And we have answers to all those questions. And so if you're a Quiver client, you know exactly how to get a hold of us. If you're not a Quiver client, one of the ways you can take advantage of getting your questions answered is we'll give you a free portfolio analysis where we dive deep and we will show you what will happen within your portfolio if the market falls, if interest rates rise. So consider it like a stress test for your portfolio, where at the end of it, we will have a very clear vision of what your portfolio could do in the future if some of the things that we've forecasted here start to unfold. So definitely take advantage of that. So let's wrap it up with that, gentlemen. Anything you guys want to add or?
I think that's good.
I think we covered it all.
All right. Well, we want to thank all of you for joining us on the 2023. Are we still taming a bear market? Quiver Financial. Have a great day, folks.
Were you asking us that question?
No.